Morning, everyone, and thank you very much for joining. This is the morning market review. My name is Russell Shaw, Senior Market Specialist at FXCM. My email address rshaw@fxcm.com, and today is Friday. It's the 11th of March. Just going to bring up our high-risk investment warning. I'll keep this on screen for a few moments, and then I'm going to show you the commentaries disclaimer and our sources for this particular webinar. Here's the market commentaries. Hey Zanetta, good morning to you. Nice to have you on the webinar as always, and welcome. All right, here is our references. I think we will use TradingView. I've got it over here. But let's go through the this is the chart we'll look at. Before we look at the chart in detail, let's just go through the headlines. European market set for mixed open with Ukraine war and surging inflation in focus. That's the headline from the CNBC morning note. The European markets are set for a mixed open on Friday as global investors react to a soaring US inflation and a hawkish surprise from the European Central Bank, along with developments in Ukraine. US consumer price inflation came in at an annual 7.9% in February, its highest level since January 1982, as food and energy costs push inflation prices skyward. Russia's invasion of Ukraine and the subsequent barrage of Western economic sanctions against Moscow has exacerbated price pressures that were already causing headaches for central bank policymakers. The huge inflation print bolstered expectations for more aggressive hikes to interest rates. The ECB on Thursday announced that it will end its bond buying program in the third quarter of 2022 if economic data justifies it sooner than previously planned. President Christine Lagarde said the war will have a material impact on economic activity and inflation. Market sentiment has been enthralled to developments in Ukraine since Russia launched its attack on February the 24th. Talks between Russian and Ukraine diplomats in Turkey have stalled without progress on a ceasefire or an evacuation passage for civilians attempting to flee the besieged city of Mariupol. Shares in Asia Pacific fell across the board on Friday, with Hong Kong's Hang Seng index dropping more than 3% to lead regional losses. Stock futures stateside were fractionally lower ahead of Friday's session on Wall Street as the Dow Jones Industrial Average headed for its fifth consecutive losing week. A raft of economic data is due Friday from across Europe, including February's German inflation print and UK's gross domestic product, construction, manufacturing, and industrial production figures for January. The UK data is actually out. It was pretty good actually. I saw the construction output was up 1.1% as opposed to the forecast number of 0.5%. Construction output is always good to look at because the construction industry is almost like a central hub. It affects so many other industries, and when construction's up, it tends to flow over into those other industries. So it's nice to see that number beating forecast. But my fear is, of course, that this stagflationary environment is still very much a strong probability, and that is yet to hit us. So markets are forward looking. This construction output is in the past. Okay, so it was a good number, but I'm not certain it actually has a bearing on the numbers coming in the future. And that's the whole issue that we're dealing with now. Uncertainty. Again, this has been the common theme for 2022, uncertainty. And it's so strange to say it's more sort of it's heightened now, considering where we've come from over the last 2 years, but I certainly feel that's the case. Okay, let's just take a look at this chart that's on TradingView. I think this is a good chart for us to also keep on top of. This is a monthly chart, so we're looking at clearly long-term trends here. And just to highlight what we're looking at, this is a relative strength of the Thomson Reuters Jefferies CRB index, and we're dividing that by the S&P 500. So we're looking effectively at commodities against the equity markets, just to get some idea of the interplay between those two sides of the market. Now, this RSI here is our normal RSI. I just want to bring up the settings. I thought it was that. Sorry, let me just adjust this. We tend to use a 10 and a median price. Okay, let's take a look and see where we are. All right, so we're getting pretty close to an overbought level on this measure. The last time we hit the overbought here, the commodities did come down, but we're going all the way back to the global financial crisis, right? But it's actually just before the GFC actually truly hits. But so it's the last overbought sort of. So we just want to keep an eye on this. Let's just put in a rectangle here. We're not quite overbought. In other words, there's still scope for upwards movement in this ratio before perhaps we do reach that elastic band point that Anna was talking about yesterday. The other key here is, of course, to keep an eye on the stochastic. I just want to see how far back the state actually goes. It doesn't go back far enough, unfortunately. I would really like to get an idea of how the ratio performed during the 70s into the 80s, because that was really the last stagflationary environment. Nevertheless, if we have to just base analysis on the RSI, remember the RSI, to me, the biggest advantage of an RSI is the readings of extreme levels. The stochastic cannot do that. Okay, cannot do that. We're getting pretty close to this 80 level, but we're not there yet. So perhaps a little bit more pain to come in terms of commodity prices. Okay, but we watch it. We watch this with very carefully. Now, the inflation that came through yesterday has a very has an associated question to it, a very pertinent question. Remember, in a week's time, so next week, less than a week, next week Wednesday, we're going to get the Fed press conference. That we're going to get the 25 basis point hike coming on Wednesday. I just don't see 50 coming in at the moment. It just seems that you're going to be adding an extra headwind to the economy you don't want right now, but you need to try and control inflation. Now, the fact of the matter is that the core number on a month-on-month basis came in at 0.5. The headline number came in at 0.8 month-on-month. The headline number has energy, it has food prices in. That's the point. Okay, in that policymakers tend to look at a core number as opposed to the headline number, because headline has what we call volatile items, namely oil and food. Right. So I guess the question here is, well, which CPI are the policymakers looking at? Now, just to be very clear, CPI is actually not the measure that the Fed uses. They use something called PCE, okay, which is personal consumption expenditure. It's a different way to measure inflation. Generally, the correlations between the two series are very close. So I think the question we're asking now is still relevant, okay? What does the Fed focus on? The core inflation number here or the headline? And generally, policy is based on core. Okay, it strips out energy, it strips out food, and then makes its policy decision. I don't think that's what they can do at the moment. I think that would be incredibly unwise to be making a decision based on core over headline at the moment because of this series that we're looking at here. The core, now with the Thomson Reuters Jeffries CRB index has a huge weighting in energy. So the fact that this is getting pulled up would be largely because of energy prices, but not only, commodities are moving up. In fact, if I have to strip out the SPX here, so if we just, instead of looking at it on a relative basis, we look at just the CRB on an absolute basis, look at this. Okay, you can see that it's pushing up. This is overbought, incidentally. But the idea here is you can see that to ignore this type of trend, okay, maybe a miscalculation. It may bring in a miscalculation because that the idea here is if you're treating a stagflationary environment as if it's an ordinary environment, okay, your monetary policy decisions are going to be off base. They're going to be off key. It's incredibly difficult to not exacerbate the problem of stagflation with any sort of policy interference. And if you are stripping out your stagflationary pressures from your data, well, that's prone to policy mistakes right there. You understand? So now, if you had to ask the policymakers, and I'm talking specifically about central bankers here, how are you going to deal with this high inflation? I think the only answer you can give, the only answer you can give, and I think this would be the adequate answer, is if you had to answer carefully. Okay, you can't just base monetary policy on core numbers when headline is actually the influential factor. Does everybody understand the conundrum here for policymakers? Usually you can strip out these volatile items because they're volatile. But we're getting to a point now when this volatility, well, it may be a little bit more sustained than in other times besides the 70s, early 80s. So there's a conundrum coming, and we're going to have to see how the press conference goes on Wednesday. This press conference on Wednesday is going to be hugely interesting. If anything, it's going to be hugely interesting just to hear what the Fed chair has to say about this, because clearly they're aware of what's going on. So I just wanted to point this out to you. Having said that, let's go now to our chart and take a look at oil just to see how it's tracking for this week. I want to break this down between the time frames as we usually do, but we'll start off on the 4-hour here. As opposed to working from the weekly down, I just think the 4-hour is giving us a fairly good idea of what's going on sort of on the ground at the moment. So just bringing this up to the 4-hour, and the whole key here is this guy. Okay, I'm not sure that we've got an answer to this just yet. The geopolitics makes it very, very difficult to come to sort of a conclusion that one could comfortably say this is more likely correct than not. And this is the question here: runaway or exhaustion gap. Okay, that's it. As we look at this, it actually looks more like exhaustion. It actually looks more like exhaustion than runaway. Why would I say that? Well, it's closed. Runaway gap means it kind of carries on running. So, in other words, have we reached the apex of this? Now, I listened to the Bloomberg surveillance interview I told you guys about yesterday, where the particular analyst said she could see oil moving to 150. She said something else interesting there. She said in this scenario, we're not actually only talking about energy prices. We're talking about the other shocks to supply, which include wheat, corn, etc. So the danger of this still being a runaway gap cannot just be dismissed. Even though the gap's closed, I think it would be foolish of us to just say this is exhaustion. Okay, I'm not going to discount exhaustion gap either, by the way, but I'm not convinced that the closing of this gap has in any way relieved the upward pressure. We have to see how this plays out. Remember, going back to our relative strength chart that we started this webinar off, there's still some movement to go on that relative strength between the CRB and the S&P. In other words, we may still see higher energy prices out. It may get worse before it gets better. Let's just keep this question mark in here. All right. Let's now take this out. I'm going to go to the weekly, and the weekly analysis perhaps does support the exhaustion scenario to some extent, and that's because of this guy here. It is clearly overbought. Now the caveat, and we've been saying this all along, we are in a highly emotional market at the moment. The more emotion associated with the market, the more likely of overshoots and mispricings. And the idea is we may get the RSI hanging out longer than expected in this extreme. Now, if we do that, that means higher prices ahead. The normalization here of the RSI, in my assessment, perhaps supports that. Maybe the stagflationary environment may not materialize. We hit that exhaustion level, and we kind of normalize back towards that $100 level per barrel. Let's keep an eye on that. So it would need to drop 11%, 12% odd just to get it to, well, 11% here, drop it by $11, give us to 100, right? So maybe sort of a 10% drop to 100 normalizes the RSI. Perhaps then, well, disaster kind of averted. The policymakers can focus more on core than on headline. But that's a big question because we know the geopolitics are still hugely escalated. All right. Let us just understand this chart. This chart actually is as a technical analyst, the chart that we're looking at here is phenomenal. We don't see this chart all the time. As I say, it's easier to see on the 4-hour, but I think the actual impact of it is more accessible on the weekly. Look what's happened here. Here's Friday's close. Okay, that's Friday's close. Here's Monday's open. Okay, so that's the gap. Okay, if we had this webinar at the open, we would see this huge gap. Look where price is now. It's dropped all the way back down into last week's range. Again, let me just bring up the 4 hour. Okay, so you can see how it's fallen back down. Go back to the weekly. Okay, and this is where I think it really hits home. Look how it's fallen back in now. How this candle closes today, I think, makes all of the difference. Okay, so will there be some sort of demand, or will there be some further pressure? We've still got this oversold condition. How much emotional energy is in the market to keep the oil market elevated? That's the big question. Now, one more observation. I just want to go back to the 4 hour. Before the gap closed, we spoke about the loss of momentum, and we were looking specifically at stochastic rolling over, falling out of 80. Okay, let's go back to the weekly. Okay, and just keep an eye on this. Okay, again, does it maintain? Does it oscillate around 80? Does it fall out? Those are the questions. Now, the normalization of oil here, this to me is the sort of the X factor, because however the oil market goes, then takes us on to our next chart. What's the next chart? Gold. Okay. Gold, remember, is that store of value, especially in a stagflationary environment. Okay. Well, we've got this sell-off over the week. As the oil market gap closed, okay, as we perhaps leaned towards exhaustion, although that's not the conclusion, we're just talking about the leaning towards the exhaustion. So money left the oil, the gold market. All right. In other words, perhaps the market is starting to discount that the stagflationary environment not quite as likely as it was on market open. The idea here is again very much coming back to runaway gap or exhaustion gap. That's not conclusively answered. Once we get a conclusive answer to runaway or exhaustion, I think market analysis normalizes to a huge extent. Okay, right now it does seem to be leaning to that exhaustion side. You guys with me there? Take a look at the also overbought. Okay, this now leads me to the next chart, which is going to be is the gold in this pair physical gold? It's a good question. Let me ponder that for a moment, Anna. I would suggest that it is based more on the on futures rather than spot. But I just want to double check that. I just want to double check that. The spot market, the spot price of gold. No, perhaps it is spot. I think it's 1 trade ounce measured to US dollar. You asked a question that's completely sort of flummoxed me at the moment. Are we looking at a spot or a future? Let me just ponder. Commodities tend to use futures as pricing. I just wonder if gold, so the oil pricing tends to be very much based off future contracts. I just wonder if that's the same as gold. Let me just do a quick Google here. I'm tending to think we're actually looking at the spot price of gold here. Spot price of gold. I'm just doing a I think this is spot, Anna. Okay, I think this is spot 1989. This is spot. Yeah. Okay, I'm looking at kitco.com, which is a great gold chart. So this is spot, I believe. Okay, so it's one physical troy ounce priced in US dollar. I hope that answers the question. One troy ounce, that's the numerator. One troy ounce in gold. Okay. All right. So the idea here is a 1 troy ounce priced in US dollar. What kind of a candle is this? What kind of a candle is this? This is a bearish inverted hammer, isn't it? In other words, okay, the way that the market opened, let's go to the daily here. Let's go through to the daily. And you can see that Friday, so here is Monday, okay? There's Monday. Tuesday, it shoots up, and then it gets faded completely. Wednesday, Thursday is just an uncertain day. So far today, an uncertain day. So you've got a doji followed by an inside day Friday, but of course we've got the whole of Friday in front of us. So it really was a big shoot up on Tuesday, a big fade down Wednesday, and that's left us with this big selling tail here. What is the big catalyst around this? In my opinion, the big catalyst around this, I'm just going to go back to UK oil. This is, I think, the big catalyst. Now, I want to show you the wheat chart yesterday. I want to bring in the wheat chart. And something remarkable happened yesterday on wheat. I'm just going to take out the Swissy. Let's just bring in wheat. What happened on wheat yesterday? Does anyone know? Look at that. This is a weekly chart. Okay, look at this. Let's go back to the 4 hour. Go back to the 4 hour. Okay. Three. All right. This is last week. This is this week's open. Here's it's kind of I was gonna say it kind of gaps up. The gap's actually over here. Okay, so the gaps, if we have to go back to the second of the third, the gaps here. This gap up moves sideways. This means it's trading limit up. It's trading limit up, shoots up, trades limit up. What does limit up mean? Okay, now we're looking at future here. This is based on futures, 100%. Yeah. So what this is okay. Futures will trade within a band. That's it. They've got limits. They've got an upper limit. They've got a lower limit. And what happens is, if you trade and you hit your upper limit, trading is going to halt. But you've got to be clear. When I say trading halts, you can still trade within the bands. You can't trade outside the bands. It's called trading limit up or trading limit down. So you had, I think you had 4 days of limit up, not in a row. I think you had 3 limit up days in a row. 1 limit up day right at the beginning of the escalation in geopolitics. What happens here? What happens here is it starts trading limit down. Okay, start trading limit down. I don't think we limit down here. Yesterday we definitely went limit down. So the volatility in the food prices. Remember that the headline number strips out volatile items. Strips out the volatile items. You can see the volatility. 4 days of limit up, 1 day of limit down. Let's just go back to that weekly chart. Here's the limit up. Here's the gap open. It's trading down. Okay. Now, let's put the oil chart next to this. Let's do it this way. Just side by side, and I just want to change. Let's go back to wheat futures here. Let's change this to oil futures here. Okay, look at the similarity here. Look at the similarity in charts here. When I say the similarity, this is where it really hits. It really hits home, right? Gap open on wheat. Gap open on oil. Exhaustion gap, question mark. You get exhaustion gap, question mark. Is this an exhaustion gap? Have we really kind of hit the apex because it's traded back down into last week's range? Go to oil. Gap open, exhaustion gap, question mark, because it's traded back down. In other words, now the implications of what I'm trying to suggest here is I'm trying to ascertain whether we're heading into that stagflationary environment or not, because that stagflationary environment, guys, it is hugely painful. Okay, it's hugely painful. It leads to policy decisions that are inherently trade-offs. Okay, because you're either going to have to focus on inflation or you're going to have to focus on employment. You can't concentrate on both. That's the paradox of stagflation. It's an anomaly. It's not the norm. That's the risk. So the fact that we have these exhaustion gap question marks, or is it a runaway gap question mark? I don't think those questions have been answered. But what I am saying is it looks like it's seems to be leaning towards exhaustion gap. That's a good thing overall. That's a good thing overall, okay? Because it means that the economics can be dealt with by policymakers. Once you head to that stagflationary environment, that's out of the window, okay? So the wheat based on oil, wheat based on futures, oil, the spot price of oil and the spot price of oil futures, different. I think that what you're looking at here, Anna, is more akin to the future. I am of the opinion, subject to correction, when you're looking at oil, this to gold, I beg your pardon, I'm all over the show this morning. This is more the spot picture. Okay, so I hope that sort of makes sense, Anna. Let's take a look at DAX. All right. Now, the implications here are, if we have that exhaustion gap, question mark, is this a potentially exploitable opportunity here? And the answer to that is, well, yes, potentially, but remember that we are in a highly uncertain environment. The idea here is, well, we could be in just a period of, I beg your pardon, a period of some sort of profit taking, some sorts of portfolios maybe going in prematurely looking for bargains. I think that it would be quite all right for us. I think it'd be quite all right for us to wait for a little bit more certainty. And one way we can do that, by the way, and this is just a thought, I haven't brought up the MACD for a long time, but one way we could potentially do that is, let's bring up a MACD here. I'm just seeing if there is I will just do it on this chart. Let's bring up a MACD. All right, so I want to take out the MACD out actually. Hold on. Let's see what this shows us. I want to keep in the histogram. Yeah, there we go. I want to keep in the histogram. We're looking at this on a weekly basis. Let's just take a look at this on a monthly. I'm going to make a point in a moment. Okay. All right. So, and let's just take out the stochastic for now, so we don't get overwhelmed with all the studies here. Let's just make this as easy to read as possible. And and then I just want to give you guys a sort of an anecdote, which I have relayed previously, and I think that's where we can kind of call it, unless there's questions. Let's go to the weekly, just for the sake of explanation. The way that you would use the MACD histogram is just measuring the bar relative to the previous bar. So over here is a good example. So that's kind of the longest bar in the histogram. Over here, it starts to shorten, and that leads into the movement up. Let's just see if we can go to a monthly. Go back to the beginning of the COVID crisis. Okay, so here's COVID here. Here's the longest bar. It kind of kicks up here. And then if you'd use this as an entry, you know, you've still got a tremendous amount of upswings ahead of you. This is still a deep histogram. In other words, waiting for some sort of tick up here might not be a bad strategy to follow. Don't take it as advice. I just want to give you where this would have saved somebody that you know, I know was looking at US oil. Just bringing up US oil, and here is the sorry, the system was just, here is now something remarkable happened here. You guys remember we went negative here on the futures market. The spot price didn't go negative, but the future went negative here. We're going back all the way to the beginning of sort of COVID, the COVID. So there was this big sell down. Now, if you went long, and I know sort of people that did go long because they rightfully were thinking, well, this is an overshoot. This is an overshoot. So they went long, but they went long too soon because they were margin called as the futures market hit negative. But their thinking was correct, that there was an overshoot here. Now, if they had used the MACD histogram and just waited for the tick up, if they just waited for the tick up, foregone the notion that you can catch the bottom, and then just held on to their position until now, well, then they would have made an absolute killing. But the fact is they went in one histogram bar too early. They went in one histogram bar too early, and they got, unfortunately, a margin called. So just based on that, you go now to the DAX. Is there an overshoot here? Yeah, probably. I reckon there probably is an overshoot here. I reckon there probably is bargains all around. How sure am I? Not sure enough to be allocating my own funds to it. Okay, I wouldn't mind seeing a histogram that has got a shallower or is not as long. Okay, so if we can get one kind of histogram bar shorter to the next, well, then there's probably bargains abounding. I don't have to get in at the low point. I just need to get in relatively low, right? So that's kind of where we're going to leave it for today. By the way, we can do exactly the same analysis on oil, just the other way around. So we go through to UK oil. Okay. And instead of using a upwards arrow, well, we can be using a downwards arrow, looking for the tick down. Okay. Looking for the tick down. Okay. This is quite a, I don't usually use the MACD. This kind of tick down here does show a loss of momentum. So we do lose momentum here, and then it kind of ticks up again. But in terms of measuring the runaway or exhaustion, okay, yeah, it's going to lag, Pete. So Peter's saying, but the histogram is lagging. There's very good reason why the histogram will lag, and that's why. And I'm suggesting that maybe the lag here, Pete, is not a bad thing. The histogram is like a third derivative of price. It's not even a second derivative, it's like a third derivative of price. So the way the MACD is calculated, you first take two moving averages. I believe they're exponential. I can't quite remember. I think you take a 12 and a 26 exponential moving average. I think you take the difference between the two. Okay, that gives you the MACD, right? Then you take another derivative, you take a second derivative of that, which is basically taking the moving average of the MACD. Okay. Then what you're doing is you're taking the difference of the signal line and the MACD. There you've got your histogram. It's too far removed from price to have anything but a lag. But the idea here is when we're looking at these extreme moves, I generally don't use MACD. I generally don't because of that lag, Pete. Exactly because of that lag. But in this case, I don't think a lag's a bad thing. It's an extra layer of caution. Nevertheless, we'll continue to monitor. Okay, so if we get a tick down in April, okay, we may see, who knows, hopefully the hostilities de-escalate, hopefully sensibilities return, hopefully we hit the negotiating table, some sort of peaceful solution is found, and hopefully, you know, we get some sort of bar moving down. Okay, maybe then we get some sort of and this is again, it's just sort of a guess. Maybe we get some sort of movement from 111 to say 80, you know, or something. But I'm saying shorting now, I'm not sure that's the best idea. All right. Any questions, guys? Go ahead and Any questions, go ahead and type those in. All right, let's wrap up here, guys. You've got my email address. Otherwise, I will chat with you guys on Monday, and wishing you all a terrific weekend ahead. Thanks very much, guys.